Hi YouTube, this is Frugal Millennial, and on this episode of Finance Fridays, I'm going to share you the criteria that I use to buy an investment property. I've been adding and refining to this list since I started the property buying journey 5 years ago. I currently have 5 investment properties and I'm hopefully going to build another one this year. You have to know, building a property portfolio isn't all that smooth sailing, especially at the start when you're getting the hang of things, and it can be quite stressful and daunting. I even sold my second property that I bought at the start as I learned that it was a dud apartment. And from that experience, I've learned a valuable lesson which I will be sharing with you today. As always, I've put a lot of effort into my research. I guess this is a good time to ask you to like and subscribe to my channel. I really hope you can stay to the end. And this isn't just for helping me out with the algorithm, but I do have a lot of information that I would like to share. I am only here to tell you my journey on how I built my property portfolio. And this is a method I use and find it works well for me, but it might not work for you. Now that it's out of the way, so these are some of the secrets I use to build a sound property investment portfolio. In general, when you purchase an investment property, use your head and not your heart. Properties are objects, so approach it from an objective point of view. Don't get too emotional about how it looks. Where your couch will go, will my buffet look good here? And why is the toilet so pink? Because at the end of the day, you're not going to live in it. In fact, I say the uglier the better. As long as it's structurally sound, you can give it your own touch later down the track. I've never bought a brand new or property that I would love to live in because I don't intend to live in it. Most of the time I bought it because I thought it will make me instant cash if I was to renovate it. For those who have watched my other videos on purchasing a house in Australia, I've mentioned how important it is to get a building inspector. And this will ensure that you have purchased a structurally sound property. And I also did a property review of my first property where I spent next to nothing renovating in order to live in. This not only helped me to get equity to purchase 2 more properties, I was also able to attract a lot of tenants. So it's a win-win. Buy in an area that the price will go up. This is almost a no-brainer. In order to grow your portfolio, you need to buy properties that will go up in value. By purchasing properties that will go up in price, you'll be adding more capital to your wealth and making your money work hard for you. In addition, when you go to the banks in a few years' time, you can access that equity by refinancing. For those who don't know what that means, the bank will essentially give you the gain in capital that you have made on the property. It's like getting paid in lump sum for the hard work. Now I have simplified this because you have to take in account of bank fees and deposit, etc. And who doesn't want a property that will go up in value? The capital gain over the past 25 years in Australia is about 7% per annum. I think as long as the growth of my properties is above this target, I'm relatively happy because I've outperformed the average. But my point is, the money you can extract then can be put towards the deposit for another investment property, and so on and so forth. And this is the secret to building your portfolio. Refinancing versus selling. Some people might wonder, why don't you sell it instead and use it to buy another property? You could do this, but it will incur a lot more fees and waste valuable time, such as selling fees and the time wasted on preparing your property in order to attract more buyers, paperwork, etc. And if it's an investment property, you then need to pay capital gains tax. As long as the property that you use to extract equity is not a lemon and still generates a decent income both through capital growth and rental income, then you should keep it to build your wealth. Location, location, location. This is the $1,000,000 question. Where should I buy? The exact location where the highest growth happen is always changing. But I do have some strategies I use to stay ahead of the trend. To do this, I will look at 4 key points. Federal and state infrastructure projects. Most of the time, it is state infrastructure project websites that I do my research on. And I look at places where they will build, i.e. a hospital, roads, bridges, schools, shopping malls, or if they will put money into an art precinct, for example. Pick an area that did well in terms of trend lines and moving averages, and then search 2 or 3 suburbs away that is below the median price of the area you like, and where the exponential trend hasn't already picked up yet. Choose the ugliest looking property on a good looking street, and make sure you get it for below the average price for the area. Find the house with fixtures from a bygone era that isn't tasteful, or that property really lacks curb appeal. Basically, a property that you don't want to live in but has the potential to be the property you would live in. Let me reiterate. I do this all the time. I buy properties that I know I will be able to generate instant cash once I fix it up. Make sure it's close to amenities such as shops, school, public transport, etc. Properties get leased out quicker if it's closer to things that people can readily access, because people don't want to live in the middle of nowhere. I just want to highlight the importance of schools. When I went to a state school that had really good track record and was the top state school in my state, it only allowed admission if you lived in the area. This drove the house price up because a lot of people wanted their children to go to the school. And for those who can afford it, bought more than 2 and rented it out. Look at the industry or attraction in the area. This is especially important if you're buying in an area you have never been to, or if it's a small town with relatively questionable growth. You need to ask yourself, what is going for this area? Is the main industry going to attract more people to the area in the future? Is the industry in this area sustainable? I'll give you an example. About 5 years ago, I bought a property a few suburbs away from Geelong. This is when the Ford manufacturing company closed down. I went against a lot of people's recommendation that Geelong is going to go down in price because there's nothing going on there. But I did my research. I noticed that Geelong is the pit stop to the Great Ocean Road, which is a huge tourist attraction. Furthermore, there's a small Avalon airport right next door, which since has undergone expansion and opened the airport to a lot of budget airlines. The main industry for Geelong wasn't even car manufacturing, but a wide range of other sectors including health, education, retail, construction, manufacturing, and as mentioned, tourism. Right now, the population growth is on par with Melbourne. The price did dip at the time, so that was when I bought in. And to quote Warren Buffett, be fearful when others are greedy and greedy when others are fearful. And that is exactly what I did because the facts and figures all stacked up. Buy where the vacancy is low. You can find out the vacancy of any suburb or town on Google. And if you can't, ask your real estate agent. And I tend to stay below the 1% mark. This is to ensure that my property will be rented out most of the time. Right now, most of my properties are rented out with very little gaps in between because I have chosen areas with low vacancy rate. The only one that isn't rented out is currently being renovated, so that doesn't really count. But that market has a vacancy rate of 0.7, so if I was to rent it out tomorrow, I would probably get a tenant very soon. Buy an area with demand and not a whole lot of supply. The vacancy rate will usually give you indication where the area is in demand. The lower the vacancy rate, the higher the demand, but this is not necessarily always mutually exclusive. You need to also look at supply. I tend not to go for areas where there's a lot of apartment complexes or high-rise apartments because it tends to be oversupplied, and the capital gain seems to always stay stagnant or the annual capital growth is very small. In addition, in Australia, there are areas that are blacklisted by banks, and they don't tend to lend you money if you were to buy in these areas. These areas are usually filled with apartments because the banks think they are in oversupply and hence risky investments. So I tend to stay clear of areas where there's high vacancy and populated by apartments. But in a lot of countries, such as in Asia, this is a whole different playing field as land is scarce and houses are only reserved for the super rich. In those countries, there are other indicators such as population growth and construction rate you need to consider in order to decide on your purchase. I don't want to complicate things in this video, so I will leave it at that and probably explain another day. Buy old and not new. I've done a video previously on how I've saved up to $100,000 by buying old properties, so you might want to check that out. In that video I highlighted buying old is the way I would go about for investment property. If you are buying to live in, on the other hand, by all means, new is probably more comfortable and just a nice treat for yourself. Without sounding like a broken record, for investment property, buying a fixer-upper will generate instant cash when you do it up. And that is instant equity that you get from the bank. Buy positively geared property. This is the foundation of building wealth through buying properties. I don't like the idea of buying negatively geared property to grow your portfolio because it drags your credit score down. When you go to get another loan from the banks, they will look negatively on your score and won't lend you as much. If you have positively geared properties on the other hand, and you are using that as an extra income stream, this will assure banks that you are capable of borrowing more money because you are treating it as a business rather than taking advantage of tax savings. Buying positively geared property also means you won't have to worry too much about out-of-pocket costs, such as repayments. From whatever you can pocket, I will normally invest back to the property in the form of renovations or upgrades. A lick of new paint or new bench tops or appliances makes a world of difference to the renter, and that in turn will make them stay on. This will not only increase the value of your property, you can justify the increase in rent each year. If you saw my last video about passive income, I find positively geared property is a perfect way to generate passive income. Lastly, research. You won't always get the right property that will increase the most in that year or that quarter. But if you do your due diligence and research right, it will never be a dud. Doing research is so important. You can listen to what other people recommend, but always verify the information by research. Look at the past history of the properties that you want to purchase. If there isn't any, look at the surrounding properties on the same street. Be a critical thinker and ask the right questions. Why is the house you're interested in $100,000 more than the one next door which looks identical to yours that sold last week? Did the house go up that much in price in such a short period of time? If so, are those increments sustainable? Does it have easements that your house doesn't have? Maybe the land size is smaller. Getting the facts and numbers right will help you make an informed decision about the property you're buying into. And remember, this is a big investment, so getting it wrong can sometimes be disastrous. So these are the main things I tick off when I buy a property. I have other minor details that I think it's more of a personal preference rather than an essential part of the checklist. If you have stayed on to the end of this video, thank you so much. I want to say hello to Jenny. Your daughter Claire said you watch my videos on property investment, so I hope this helps. I want to say hello to Rochelle and Lisa for asking me questions about property investment. I am always happy to chat more about property investing because I love this topic, so message me. I want to say hi to Sophie, Anastasia, Alex, Hayden, Kenny, Yaz and Tang for watching my video. Lastly, if you want to get a free stock from stake.com.au, which is worth up to $200, please use my referral link below. Thanks for watching. I would like to make a disclaimer that I am not a financial advisor. You should seek professional financial advice just to check that my information is correct before you make a purchase.